So it gives me great pleasure to welcome our next speaker onto the stage, Gustavo Medeiros. Gustavo is the head of research at Ashmore, a global emerging market debt specialist based here in London. Gustavo's got great experience managing both local and hard currency mandates, and is certainly a passionate communicator on all things macro. And if our debates over dinner last night are anything to go by, you're in for a real treat today. So without any further ado, Gustavo, welcome you to the stage.
May we live in interesting times, right? I think you guys been getting quite a lot of very interesting presentations from various different managers, but I'd like to start mine with some global macro thoughts, because I think we are at a very, very different moment, and portfolios that we are building for the next 10 years will probably have to be very different from the way we built portfolios over the last 40 years. There are many structural changes in the global macro backdrop that will call for that, and I'd like to start discussing some of these changes. And the first, you can see that I have 3 topics on the short term and 2 topics on the long term. In the long term, there are 2 crucial changes in the global macro environment. First, we have to get ready to invest at times of geopolitical conflict. And obviously we have a war in Ukraine, which is a war in Europe, which was unthinkable before. But over the last 5 years, the largest countries in the world, the United States and China, have been engaging in every aspect of conflict, from a technological conflict to a political conflict to a trade conflict. We are in a conflictuous relationship in all aspects except for an actual war. And it's a very complicated environment, and it's interesting because most of us that have been working in finance for the last 20, 30 years have learned to invest and to think about the macroeconomic backdrop, monetary policy, fiscal policy, political risks. You have to insert the geopolitical risks on part of it. So we have, our heroes are the people that inspired us, George Soros, Stan Druckenmiller, Mark Coombs, the guy that I work for. They were very, very good at anticipating global macro backdrops based on monetary policy and these events. Now I have to read more John Maynard Keynes, what he was writing about how to invest in the Second World War. We have to read more about the Rothschild and how actually they made a killing during the Napoleonic Wars when ultimately Napoleon got defeated. Luckily, in a slightly less daunting picture, there are 2 rules of thumb that have been working fairly well over time. The first one is you want to invest in countries and companies that are neutral to the conflict. These companies and countries can capture arbitrages on trading across both parts. Think about India, for example, where Apple just announced an investment of a new factory, and at the same time, India is buying Russian oil at 30% discount, right? Looking after its own self-interest. The second rule is obviously you want to buy the winners and sell losers of geopolitical struggles and conflicts. It's very hard to say who is going to be the winner of this, these economic disputes that we're having between China and the United States today. But if you don't know who is going to be the winner, you should diversify your assets. You shouldn't put all your eggs in one basket, because you don't want to be caught in a position where you have a lot of allocation on the loser of a geopolitical conflict. And the second point, I think you've heard many times here, we're going to get a much different environment in terms of growth inflationary backdrop. Over the last 40 years, 70% of the time, or 70% of the years, the developed world economies were in an environment that we call Goldilocks, which is a phenomenal environment for investors. We have above average and above trend growth, but also below average and below trend inflation, right? This is the top left on the quadrant. Now, what I think is that over the next 10 years, we're going to be alternating much more across the other 3 quadrants here, which is either an economic boom that we've been living since pretty much the 4th quarter of 2020, and policymakers overlook that, or we're going to be discussing, right now we're discussing whether we're going to go to a stagflation, which is pretty likely that we're going to see in Europe, or we're going to get a recession, right? And quite a lot of people have been talking about it. And there are 5 key structural reasons here for why I think that we're going to see a very different environment for Goldilocks. None of them relate to the war in Ukraine. So the war in Ukraine is just accelerating that trend. The first one is that we have too much indebtedness in the world, particularly after the COVID fiscal response. And that will force central banks to keep policy rates at negative levels in real terms. Otherwise, the economies are going to suffer significantly. So I see central banks reacting in a similar fashion to what central banks were doing in the late 60s, early 70s. They were always going to try to react, always going to try to fight inflation, but they're never going to do enough to actually kill inflation once and at all. And particularly, considering that we have the two other trends are very important and very similar to the 70s again. If you remember in the 1960s, one of the most important policies coming from the United States was Big Society by Lyndon Johnson. So we're trying to reverse inequality back then. And when you reverse inequality, you actually take money away from people that have allocations in financial assets and give it to poor people, which at the end of the day translates into more demand for commodities. And that's exactly what we're seeing since COVID, right? COVID was a slap on the face of society, of politicians, and showed how inequality has been grotesquely widening over the last 40 years. If you were top 1% of the population, you had a pretty good time during COVID. It was very stressful. It was complicated. We were fearing for our lives and for the dear ones. But if you live in a dwelling in India, that was that was proper hell, right? And across the world, everybody's trying to put policies to reverse inequality. Typically, that leads to a super cycle in commodities. I don't think this time is different. And together with that, we're talking about energy transition. And so far, the finance industry overall took a very thoughtless approach to energy transition. We're trying to kill supply of fossil fuels, which is responsible for 80% of our energy matrix. Obviously, that is going to create energy shortages, which obviously got compounded by the war. But I think that we are tight in terms of supply of oil and copper and all industrial metals at a time that the reverse of inequality is going to lead to higher demand. Then we're going to start getting regulation in big tech, which we haven't seen over the last 10, 15 years, and as a result of inequality as well, and then a pushback against this hyper-globalization. And we're going to build supply chain redundancy, so we cannot have China producing everything that we consume in the world, particularly given the geopolitical backdrop. And we're going to try to bring supply to more friendly places, but also build up more redundancies that in the COVID shock we learned it was complicated. So these two, this is very important to keep in mind in the long term. In the short term, I think we have been having three key issues, which is China's zero COVID-19 strategy leading to a stronger economic slowdown than everybody expected on the economy, monetary policy tightening by the Fed, and again, here was, we've seen the Fed doing 75 basis points twice, which on my 22 years of career I had never seen before, and you got to go back to kind of like Volcker era to see this aggressiveness. I'm not saying they've done they are uber hawkish and they're right. I'm just like they were after being behind the curve for at least 12 months, they overreacted. And now they're hiking into an economic slowdown that is being caused by the war and is being caused by these shortages. And finally, the Ukrainian war. And I think here the important thing to understand is the unintended consequences of the economic sanctions, which is even more grave as we've been learning now in Europe than the intended consequences of them, right? And so again, this kind of like map helps you to think about neutral countries. So this is a map showing which countries voted to suspend Russia on the membership of the Human Rights Council. And you can see that countries that are in cream abstained, countries that are in red were against it. I had another two maps here that in the interest of time I removed them. But overarching conclusion is that the vast majority of Latin American countries, including Brazil and Mexico, interestingly, most African countries and most of Central Asian countries will remained kind of like neutral to the Russian-Ukraine conflict and are likely to remain neutral to any geopolitical struggle that comes, simply as an economic reality that these countries cannot detach or decouple themselves from either the United States or the Chinese economy. This is the booming economic environment. This chart is very interesting. It basically shows the environment that we live. This is a very long-term chart that shows the history of real interest rates over the last 700 years. Is a chart by a paper in the Bank of England, which I encourage you reading if you're interested. But what I'm interested here is the period right after the First and the Second World War, when the global central banks kept monetary policy below inflation for a decade plus, right? And this is an environment, if you look at the fiscal expansion that we had during COVID, it was comparable to the First and the Second World War fiscal expansion. And I think that's what we're going to require. And if you would update this chart that finishes in 2018, you would see that we hit minus 9% because inflation hit 9% when the Fed fund rate was very close to zero. And we're now going slightly back to minus 5% area as Fed fund rate increases and inflation declines. This is the inequality picture that I mentioned. So the top 1% of Americans used to control 10% of aggregate income in the 80s. Today they control close to 20%. The bottom 50% used to control 20% of the aggregate income. Today they have about 13%. That's mega deflationary, right? Because you're taking money away from people that have pent-up demand for food, shelter, car, every durable and non-durable good, which translates into demand for the real economy, and giving people to the wealthy part of the population, which are going to buy S&P 500, are going to buy stocks, are going to buy emerging market bonds, are going to buy financial assets. So the reverse of inequality obviously has to be inflationary, and that's where I think we're going. Just kind of like to give you a number, to give you an order of magnitude of like the commodities importance, Citibank estimates that in 2019, the world spent about $6.3 trillion in commodities. Today, we're talking about $12.5 trillion. So the share of commodities as a percentage of the global GDP increased from 6 to 13%. And again, energy transition is part of it. It's this table here is the highlight of the table is taking the numbers away, but you can see the share of each of the key energy component on the matrix from the 1980s, 1990, 2000 until 2020. And in 2020, 83% of our energy matrix was dependent on fossil fuels. So obviously, there is no transition to clean energy that doesn't come that won't require fossil fuels in the short term, and starving this sector out of capital was complicated. Again, China was a key deflationary force as well over the last 40 years, not only because they got an army of 1 billion people joining the labor force, but also because they've expanded their energy consumption via burning coal, which is, if you're an environmentalist, it's a terrible source of energy. If you're an economist, it's a fantastic source of energy. It's extremely low in terms of volatility. The price level is lower than most other fossil fuels. And China burning coal actually allowed for, allowed the world to actually produce much more goods much cheaper. Now, China is committed to the energy transition. 90% of the solar panels that we get manufactured comes from China. Most of the wind turbines that we have come from China. They understand it's part of their strategic plan to clean up, China's air and to clean up the world's air. And the question here is not only if the countries are not committed, like China and India, for example, are very committed. Europe is very committed. The US now is extremely committed. But the process of how did that take place, it's going to be complicated, particularly given its starting point. Now, in the short term, I'm actually seeing quite a lot of deflationary forces to the economy. So whereas I think that over the next decade, we're going to be in a much more inflationary environment, over the next 6 months, I see a lot of disinflationary pressure. So on the bottom right, you see commodity prices rolled over from the lows, and industrial metals in particular are now low in year-over-year, below 1 year ago, so declining in year-over-year terms. And gasoline prices in particular, which is a very key component of every single gasoline and diesel prices, which affect every single goods and services on society, have been declining quite significantly since mid-May. On the bottom left, you see the house affordability in the United States is very similar picture in the United Kingdom. It's going to look very similar in Europe very soon. You can see that workers, the average worker in America used to have to deposit 11 months of their income, assuming to buy an average house. Today they have to deposit about 18 months or 17 months to be precise, the mortgage payment will take close to 50% of their income today, which is twice what it was only 2 years ago. And then obviously that's a consequence of higher house prices and higher interest rates cost. And on the top left, you see that real wages have been running already at negative levels for 12 months. And if we start getting unemployment as a result of that, and on the top right, you can see the quit rates have peaked and is a good leading indicator for wages, then obviously we think that we're going to get a lot of pressure off the labor market. Interestingly, if you look at the leading indicators, the developed world economy seems to be slowing down, which is consistent with a recession. The manufacturing PMIs are now at below 50 levels in the developed world economies. Sorry, the composite PMIs are below 50 levels, which is the combination of the service and manufacturing PMIs. As you can see, the manufacturing PMIs have been decelerating quite quickly, dropped 5 points in the developed world to 51.3, whereas interestingly, in emerging markets is buckling the trend to the extent that the PMIs are actually improving there. So manufacturing is picking up in emerging market countries. So you see the vast majority of EM countries are getting new orders and output positive growth, i.e. the PMIs are above 50 and is actually improving. And I'll let you look at it in more detail if you like, or ask questions in more detail if you like. But it's interesting that against this environment of a recessionary backdrop in the developed world, EM is doing much better. Now, EM has been going through a very, very rough time over the last 18 months. It's very interesting that, you can see that this on the left-hand side is the performance of local bonds overlapped with the Fed fund rates. Typically, what I try to show on this chart, local currency bonds actually perform quite well on the Fed hiking cycle. The best time performance horizons for local currency bonds was from 03 to 08 and from 2015 to 2019 when the Fed was actually increasing interest rates quite aggressively. Increasing interest rates, but very, very, like on a moderate basis and anticipated and gave plenty of signals to the market in advance. The problem, obviously, we have today is that the Fed has been extremely aggressive and we couldn't yet figure out what is going to be the terminal rate. So the fear of the Fed and the repricing is still with us. And at the same time, now that we're starting to talk about terminal rate and peak Fed hawkishness because of this disinflationary points that I mentioned, and because we will see this rate hikes impact in the labor market quite soon, we're talking about a recession, which is also an environment that is not positive for EM. But bear in mind that the total return of local currency bonds have been at close to minus 20% over the last 12 months, and it has a big, big gap between commodity prices and local currency bonds, which typically has a very strong correlation, which we're not seeing now. I think that this is a massive value opportunity, which is going to be, which we'll be able to harvest quite soon. One of the reasons why local currency bonds have not performing well is that EM currencies have been underperforming, right? And this is a nominal EM currencies, a chart that shows that currencies depreciated by basically 50% of their value from 140 to 70. And on the left-hand side, you have currencies in real terms, in real effective exchange rate. And you can see that the mirror image of EM depreciation in real terms has been a very strong appreciation of the US dollar. And that's exactly the key reason why EM assets have been on their back foot. The dollar plays a huge, important role into what happens across financial flows around the world, and EM is not exempt for that. Now, the main reason why the dollar has been on a tear over the last 5 years is because the US has been running pro-cyclical fiscal and monetary policy. Since Trump got elected, the US has been running massive fiscal expansion. What was the first thing that Donald Trump did when he came to power? He cut taxes, right, to American corporations. So if you're a global equity manager, you're looking at the bottom line of American corporations improving as a result of lower taxes, not Mexican companies, not Japanese or European companies, right? So what you're going to do, you're going to sell your stocks in the rest of the world and buy stocks in the US. And what was the first thing that Joe Biden did when he came to power? Second round of paycheck when the economy was already overheating, right? So pro-cyclical fiscal policy again getting implemented. And everything that comes out of Joe Biden is pro-cyclical. There is more fiscal spending there. Now, the American economy is extremely imbalanced. If you look at the amount of capital the foreigners have invested in the US, we're talking about basically $52 trillion, whereas Americans have only $34 trillion invested in the rest of the world. So that gives the US a net liability of about $17 $17.5 trillion, which is equivalent to 72% of the GDP, which increased from $8 trillion before Trump. So there was $10 trillion capital going to the United States in excess of capital coming out of the US, which means that most of the assets of the world have been allocated at the margin over the last 10 years in US assets, which are extremely expensive at this time. No EM economy would be ever allowed to run such a massive external imbalance. The currency would be already selling off quite significantly in that result. And interesting, on the last bullet point, you see the breakdown of foreign ownerships on the asset side. So foreigners own today $7.5 trillion of US treasuries and $15 trillion of US stocks. So in a risk-off environment, a proper risk-off environment that investors decide to get out of stocks, the US should actually suffer, right? Which is interesting because typically the dollar rallies on risk-off because people precisely buy US treasuries, which tends to protect your portfolio in risk-off environments, but it hasn't been really working so far in 2022, right? Because of the Fed reaction function. And that's that is the most interesting chart, which shows why I care a lot about the dollar and why I've been discussing that. This is the ratio of the total returns of the MSCI EM to S&P 500. Sorry, the ratio of returns without including dividends of the MSCI EM to the S&P 500. And you can see that it follows the dollar pretty closely, right? The orange line is the inverted broad dollar on a trade-weighted basis index. So from 1995 to 2002, the dollar strengthened by about 35%. EM stocks massively underperformed the S&P 500. From 2002 to 2012, you had China becoming the key country, kind of like the key producer of manufacturing goods of the world. You had a lot of investment coming to emerging markets. Commodities were doing quite well. The dollar depreciated about 35%, and the ratio of MSCI EM to the S&P came from 30 at the bottom to 120 at the peak. So 4 times outperformance in emerging market stocks versus the S&P 500. Now, nobody wants to know about EM assets, stocks, or debt, because over the last 10 years, it's been a pretty tough environment. The dollar has been strengthening, commodity prices have been declining, the multiples of EM stocks have been derating, whereas US stocks have been re-rating, and that explained the massive underperformance. So when, in my view, the next leg of the cycle is going to be, let's get out of overly expensive consumer discretionary tech stocks, things that benefited from this globalized, low inflation, Goldilocks environment over the last 10 years, and let's buy into value, into commodities, into things that will be important in a world where we're trying to revert inequality, where we're trying to do energy transition, and those are emerging market assets. On the debt space, you can see that the high yield MB, which is the sovereign debt part of the asset class, is trading at close to 1,000 basis points over Treasury, which is pretty much the same level that we traded at the worst moment of the 2020 COVID crisis, and the same level that we traded in 2008, 2009. Obviously, within the sovereign space in emerging market debt, you have quite a lot of countries that are going through balance of payment crisis. Not the large, big emerging market countries like China, Mexico, Brazil, Indonesia. Those countries are doing super fine. Most of their debt is in local currency. They don't have a dollar debt problem. So the currency depreciation do not affect their balance sheet too much, and they're running much more stable current account balances. In some of the countries like South Africa are even running current account surpluses rather than deficits. But you have countries like Sri Lanka, Pakistan, the importers of commodities that were running over-levered balance sheets and too much dollar-denominated debt that are going through that restructuring. There's going to be quite a lot of relative value to take advantage of on the high-yield part of the asset class, but overall, you get massively overcompensated for the risk that you're running here. Now, the special topic that I have for today is actually China real estate, because it's a topic of interest of Robert and the team of Momentum. It's probably the most distressed sector in emerging markets that I've seen since the beginning of my career. It's hard to see one single sector that is so large and it has dozens of companies or close to 100 companies, where the entire sector trades at 7 cents on the dollar to 20 cents on the dollar, and some few companies are trading at 30 to 50 cents on the dollar. And let's talk a little bit of what happened here and why we think that you have an opportunity to pick up some of these highly distressed assets that have a very big upside vis-a-vis the downside that you have at this point in time. So what happened in kind of like, I'm going to go to the end of the presentation because we have a sequencing of the multi-stage crisis here. And what happened basically in a nutshell was the beginning of the crisis came in mid-2020 to mid-2021 when the Chinese government implemented what they call the three red lines policy. So basically they put three ratios limiting leverage on the developers in China. And Chinese property developers have been running a very levered balance sheet for a long time. And basically the government was saying, that's it, we have to rein in your leverage and you have to actually reduce, improve your cash generation, et cetera, et cetera. We took it as a sign, from a big picture that was a positive measure to the extent that was actually encouraging or, forcing the developers to delever their balance sheet. The problem came as a result of the Chinese banks and the Chinese asset management companies over complying with the regulation in China. So everybody got, oh my God, this is a sector that we thought it was too big to fail. Suddenly, the Chinese government wants them to delever it all of a sudden. So the capital got drained totally out of the sector. And without working capital to keep on building their properties and a levered balance sheet, companies started going into liquidity problems one after the other. They have decent assets, they have, to cover the majority of their liabilities in our view, but liquidity problems have been a key concern. So in the first half of 2021, we already started to see the first defaults. Evergrande was towards the end of this period and Fantasia, but towards the end of the 2021 and the beginning of 2022, the vast majority of Chinese real estate developers were already in trouble, and the final straw that broke, the rest of the camel's backs were the second leg of lockdowns and China maintaining its zero COVID policy strategies, which basically locked people down in Shanghai, Beijing, which are key financial centers, reduced confidence of the Chinese population, and led to these people stopped buying properties, and obviously the liquidity situation got even worse. Now, the problem throughout that is the government, the central government and the provinces have done very little to alleviate these acute liquidity crisis that's happening in the sector. And that is what has been changing since the beginning of the second half of 2022. We have the governments, both the central government and local governments, putting together funds in place that to help the developers to finish the properties that were sold but had their buildings interrupted due to the liquidity crisis, which is a very important step to rebuild confidence on the sector. At the same time, we had the government guaranteeing the issuance for four developers, four of the large, healthier developers, and that list has been expanding to 6 developers over the last week. And finally, some of the provinces, like the province of Henan, where the vast majority of problems in the real estate in terms of sold but not delivered properties yet, announced a fund on its own that will actually inject liquidity on the construction companies. So we think that, that considering where China real estate is trading, so you look at the single B properties trading at close to 5,000 basis points over Treasury, again, in line with cash prices that are, below the low teens in some cases. Double B names are trading at 4,000 basis points, and even which are the relatively healthier names. So this is a kind of like a more detailed timeline into what happened, but the story is relatively similar here. So we think that real estate is still an extremely important sector for China, and I don't have this slide here, but just to give you a statistic which corroborates our thinking, today about 64% of the Chinese population live in cities. So the urbanization rate is at pretty low levels. If you look at Mongolia, for example, 78% of the population live in cities. In Brazil, 84% of the population live in cities. So as China continues to develop, they're going to incentivize more and more people living to cities. So if this 20% gap from China to Brazil closes, we're talking about more than 200 million people moving to cities. So despite the fact that the demographics of China, i.e. the working age population, will be declining, the vast majority of this working age population will be also migrating to cities, so there will be demand. And this is a sector that is extremely important for China. There's no way that China is going to go through the middle income level with a property crisis similar to what Japan had in the 80s, 90s. The Chinese leadership, the politicians have been, very acutely aware of these problems that they had in Japan, and I think that the measures that they're taking now shows that they care about the situation. So this is an opportunity to diversify your portfolios, getting into a sector that is very, very idiosyncratic, that it trades with a very low correlation across most other assets. You're buying distressed assets at very cheap levels of valuations, and you're buying assets that are too important and too big for one of the largest countries in the world to fail. So that's the special topic that I had.